We're coming to you today to give you a brief overview of our most recent white paper, which is titled Private Credit Under Pressure. Now, in this white paper, we address some of the recent events we've seen in the market, specifically in the public market. Blue Owl is one of the names that some may recognize from the news headlines, which had to stop redemptions of one of their semi-liquid credit funds in order to meet just this influx of those trying to come in and get their money out. Now let's talk about what's happened and why this has spilled over into other names that are in the asset management area. We're looking at the S&P 500 Asset Management Index down over 15% from its recent peak. So there's a few catalysts that are driving this uncertainty in these asset managers. These managers make private credit loans, and they are selling these in a format that is semi-liquid. It's not the true alternative market that we talk about a lot here and in our podcast, the alternative view. So the main reasons behind this is the default fears. There has been an increase in default fears because of the overspending in AI. Specifically, what companies will AI disrupt and what companies won't be around after we get this full evolution of artificial intelligence? You're seeing that specifically in software stocks. And you can see in this chart that the S&P 500 software index is down more than 30% from its recent high. And these software companies, a lot of these alternative asset managers that sold these funds had a lot in these software company loans. About 20% of business development companies make up that software loans. Another catalyst is the weaker lending standards that we started to see in the aftermath of the pandemic. Now, we're not talking about 2007, 2008, and 2009, but we did see, because of the demand was so high for private credit, it is an attractive asset class. We saw the demand so high that companies were able to loosen lending standards. Pay in kind is one of the areas that they did we started to see a lot of issuance in the pay in kind. And then we saw structures. So the structures of these get where there was no more cash flow testing. They weren't following minimum EBITDA requirements. These things now have created some concerns that we can see these defaults, especially as we mentioned in the software space. We're also in the middle of a refinancing wall. Remember, the pandemic was about 5 years ago, and the issuance we saw in the aftermath of the pandemic is coming due this year. It's estimated that there's between $300 and $500 billion in that private credit space that needs to be refinanced this year. And then the most important thing that we're seeing that has spilled into the public market is the liquidity stress. And that's been highlighted by the Blue Owl situation. Typically, private credit is long in duration. It's not meant to be liquid. So if you have a lot of people running to try and redeem their money from something that's semi-liquid, they have to put up these walls, and liquidity becomes a major issue. It's not always a credit issue. It's just there's too many people trying to chase money that's not liquid for these companies to sell. Now, what's the difference between the public and the private market? We've seen this indiscriminate selling in the public market, and that's where that liquidity becomes a problem, because all of these asset managers, we're seeing it started with Blue Owl, and we've seen it spill into other asset managers because, again, indiscriminate selling. This is a fear. People get concerned about what's out there, the lack of transparency in this market, and you see indiscriminate selling. You don't see that in the private space. So let's talk a little bit about the private space as well, especially how we look at private credit. Remember, this is meant to be an illiquid alternative investment that's meant to be for the long run. Typically, they give great risk-adjusted returns, cash flow, and non-correlated asset. This is still a very important asset class that we're not pulling away from. It's just that it highlights how important the due diligence process is. We are consistently looking at the management structure. We're looking at some of the underlying loans in these structures. We're making sure from the liquidity standpoint that the managers are focusing on that and they don't have a liquidity stress. We're also looking at leverage. How much leverage are they using? Are they instituting weaker lending standards? These are all things that we are focusing on in that truly illiquid private credit space. So to sum up, this is something something that's impacting the public market, we see what can happen in the public market when just that fear and momentum, it can quickly drive stocks higher, but it can also drive them lower, where much lower than you would expect, and actually even start to look attractive from a valuation perspective. We don't think in the public space this is completely a credit situation. It's just turned into a liquidity crunch here in that public space. In the private space, we still feel very strongly about that area, but again, we're making sure that we're looking at the very best managers that won't run into these situations that we've seen in the public market. And remember, it is illiquid. It's a private alternative investment. So you're not subject to dealing with this daily volatility and these kind of run-on stocks that we're seeing in the public market. Thank you very much. And if you would like, we would like to invite you to some of our podcasts, whether it is the Markets with Megan, where we talk about the markets, the economic data, what it means for the investments. The Alternative View, our head of due diligence, Matt Angelat, talks a lot about illiquid investments, how you invest in them, how we look at them, how we do our due diligence on them. And then From the Ground Up is our CEO, Leo Kelly, and he talks with business owners on how they built their business from the ground up and also focusing on the business exit plans. Thank you very much.